Hello there, my name's Miles Pitcher. I own Superior Lending. I'm an all-in-one expert. One of my favorite loans to do, and I appreciate you checking out this video. My goal today is to help you to get introduced to it, understand the power of it, so that you can decide for yourself if it's going to be a good choice for you to look at. All right, let's make this a little bit bigger. So the all-in-one loan has been around since 2005. And by the way, if you are here to check out what the 2023 updates are and you know about the all-in-one already, I'll put down in the description a timestamp that you can jump forward to and just see what's new for 2023. But let's start out on the all-in-one loan. And really, why are we looking at reimagining or having an alternative to the 30-year mortgage? Well, the fact is that most people have to borrow to do real estate. 90% of the people who buy real estate have to use a 30-year mortgage. And we're really kind of getting in some tough spots in our country on debt and things like that. Home prices rising up severely, and you've seen that. And then income not really matching the growth there. Mortgage debt is getting huge in the country. And the other problem we're seeing a lot of is our senior citizens. The retirement income is really falling short of what's needed. We've actually seen quite a few of our seniors get hit pretty hard with what inflation is doing to their expenses. All right. 42% of people's income goes to cover their mortgage right now. That's a huge chunk. It's almost half their income on there. Now, on a 30-year mortgage, it's been in place. It's a very archaic loan product, in fact, and it had a great purpose. It still does in the right situations. But for those who have had a mortgage, you understand and know that first mortgage payment is so front-loaded with interest. It's really painful. And it's a one-directional type of a mortgage, meaning you make a payment and any extra you pay just stays there in the mortgage. You don't have access to it. You don't have liquidity. And in fact, 50% of what you pay, or 50% of the interest you pay on the whole loan, gets paid in the first 10 years. So this is why banks love them, and why we also want to look at providing an alternative to this 30-year mortgage that will use simple interest rather than amortized interest, and really harness the power of reducing the mortgage interest in years on somebody's loan. So I already said a little bit about this, but we're looking for a loan product that gives us flexibility. It also we want it to give us access to our funds and our equity for 30 years, not just a one-way type of a thing. We also want a product that can help us to get out of debt faster, reduce the years of our mortgage, and reduce the amount of mortgage interest that we're paying without changing our budget that we have. So take a look at this. This is a typical loan that we were doing back in 2018 to 2021. 3% mortgage, $625,000 home value, and then $500,000 mortgage. Even at that, look at how much interest was being paid on that loan. $258,000. That's a 22% increase in the home price with just 3% interest. Now, what does it look like with a current rate of 6.5%? $637,000 in interest. That's an 82% increase in the home price at that interest rate. Pretty crazy. So 30-year mortgage, there are some positives to it. I don't want to totally trash on it, but it does tend to be a good spot or a good thing for our first-time home buyers because they understand it. The education has already been there. They're used to it. It's a good spot for our clients that don't have large monthly cash flow, meaning their budget, what they're spending is just matching what they're earning. And so it's a good, stable payment that works for people like passive income earners who need to stick within that budget. The last one is very true in that a 30-year mortgage is almost like a forced savings plan for those who aren't good at budgeting their money. And they need that type of a loan where they make that monthly payment, part goes to principal, part goes to interest, but the equity is locked away. So it's a forced savings account for them. The negatives of a 30-year are that it's slow, inefficient with the interest being front loaded, no liquidity or it's rigid, and it can be super, super expensive, as I showed you in some of those slides a minute ago. So what's our alternative? Well, we want to look at this all-in-one loan to see if it works for us, and I believe it's a smarter way to borrow. So let's take our current mortgage that we have, a 30-year mortgage, and we're going to replace it with a first lien position 30-year HELOC. And I want you to know that this is a different HELOC than you would get at your bank or credit union. At a bank or credit union locally, that HELOC you get from them will typically be a 10-year draw period, and then they freeze it and require you to pay back the interest or pay back the balance over the next 20 years. They amortize it over 20 years. So ours is a little bit different. It's going to give us 30 years of access to that money with that 30-year HELOC. So as we put money in, we're going to drive down our principal balance and increase our amount of equity that we have in there. We also are going to maintain that liquidity that we can pull the money out over any time over the 30 years. So let's look at this visualization of the HELOC or that's in the all-in-one structure. So along the top there, you can see the HELOC limit or our credit limit. It's going to remain level and constant for the first 10 years, but right after year 10, it's going to start stepping down 1/240th, which is 240 months is 20 years. And this is the way that the bank ensures that they're going to get this paid back, so that by the time you reach 30 years, your credit limit will then hit 0 and you will have paid back the loan. This blue represents the loan principal. And with an all-in-one loan, typically we see our clients paying off way faster than a 30-year mortgage. And then that green section, teal, whatever you want to call it, remains available as equity to them 24 hours a day, all the way through the life of the loan. Let's put some numbers to this and just say our credit limit's $800,000. Okay, $1 million home, $800,000 credit limit. That credit limit is that level part of the top line and will remain that credit limit for 10 years. Then it's going to step down every month by $3,300 until it reaches 30 years. Hopefully that makes sense to you. Now, some of the highlights of this loan program, they're pretty cool. There are no prepayment penalties. You can pay it off as soon as you want. If it's not for you, you can refi out of it if you want, or you can sell your home and pay it off. There are no prepayment penalties. Again, I mentioned already 30 years of access to equity. We can do loans up to $3 million, and this is awesome. It used to be $2 million. Now we're up to $3 million. It's phenomenal. In the all-in-one loan, they do not really treat the conventional or conforming limits or take them into account. So on a normal traditional loan, once you go into the jumbo range, it's a whole different ball game, different rules. Our loans very much have the same guidelines, and there's really no jumbo category. You can do purchases, refis, primary residence, second homes, and investment properties. This one's really cool. You can do them on single family homes as well as up to 4plexes with this loan product. Super, super cool. I have all-in-ones on my primary residence, and I have it on one of my investment properties. So I personally use these, and I'm a huge fan of them. All right. The all-in-one really is for clients that are the best of the best. You can see that a high credit score is needed. And then this loan to value, we can do as little as a 10% down all-in-one loan on a purchase, or if you're doing what we call a rate and term refinance. And that's where we're just refinancing the current mortgage balance and not building a credit limit any higher than what is currently on the mortgage. Typically, my clients are doing 20% down, because if you do 10% down, then you have to deal with what we call some single premium mortgage insurance. And I'll talk more about that. Investment properties, 75% on there, 43% max DTI. So DTI stands for debt to income ratio, and that's a measure of what percentage of your income goes towards paying your monthly debts that you have, like car payments, credit cards, and this mortgage that you're getting. So 43% is a little bit tighter than what the standard mortgage would be with conventional or FHA. The other thing that it requires is reserves, and that can be 10 to 15% depending on what your debt ratio and loan amount is. But those reserves have to be money in the bank, brokerage accounts, retirement accounts, verifiable funds that we can show are accessible. And that honestly tends to be one of the biggest hurdles for my clients, is showing enough reserves on an all-in-one loan. Bottom line on all this is the client needs to have strong positive cash flow. If they do, meaning they are earning more than they're spending, the all-in-one typically will make really good sense for them to look at doing. So the rate structures are broken up with 3 different options. We have a 5-year fixed, which means it's fixed for 5 years, and then it is adjustable after that. 3-year fixed and then adjustable after that, or a 1-month adjustable where it adjusts every single month. These are adjustable rate mortgages, so you need to be fully aware of that. There are some caps, meaning like lifetime caps, and then there are some floors on them that do help protect you. But you need to fully understand that that is part of this loan, and sometimes it plays to your advantage, sometimes it's a risk. Rates have risen up lately, but we are more focused on this loan on how much mortgage interest we can save rather than what our interest rate is. So let's look a little bit at this, and I think I went too far. There we go. Let me hop back. All right. So how do you figure out the rate? I'm going to make this a little bit bigger. So this is based on the 1-year Treasury index, the CMT, and the CMT stands for Constant Maturity Treasury. It's a good index. It's pretty stable. So we take that and we add to that our margin. And the margin, whatever that rate is, like 3.75 margin, that will remain constant throughout the whole life of the all-in-one loan. The index will move once you're in an adjustable period, whether you're doing the 1-month adjustable or say you're doing the 5-year fixed, then adjustable. During the adjustment period, whatever that index is, they'll take that plus the margin, and that's what your rate will be. The lifetime cap is put in place at the time you close, where you take your fully indexed rate, add 6% to it. That's your lifetime cap. The floors are 3.75 on primary and second homes, 4.75 on investment properties. If you look at that chart, you can see back from like 2020 through the start of 2022, we were super low. And my all-in-ones were hitting the floors at that time. They could have been lower, but they were at 3.75. So you can go look in Google and online and see what the CMT is doing and where it's at. But I always remind my clients, you need to be aware of what your lifetime cap is. And if you were to hit your lifetime cap plus have your line fully drawn, you can calculate what your payment's going to be or how much interest it would cost you, and you need to be aware of that. You also just keep in mind, we're here to save on mortgage interest. Okay, so let's show you the power of this now and how it really works. So we've already shown you that we have that first lien position HELOC, 30-year HELOC. What we do is we take that debt instrument and we combine it with a banking instrument. And that's what makes the all-in-one so powerful is we have a automatic sweep account tied to an FDIC insured bank account. That bank account has all the normal features of a bank account: ATM, check writing, online banking, customer service. You can send wires out of it. You can do bill pay. It's all there. But the feature that is super cool is the sweep feature. So every night that you make a deposit into that bank account, the money will automatically sweep over and pay down your HELOC. So at the end of the night, your checking account will show zero because all the deposit has swept over and reduced down your HELOC or mortgage balance. That's what saves you on the interest. Okay. Super, super powerful. And now think about your household expenses. This chart here is just to help you realize that many of the expenses you pay for do not all come out at once. That money sits idly in your checking account for quite a while before you have to pay them. Why not have that money sweep over and reduce your mortgage balance, save you in interest before you have to pay them? And then when it comes time to pay them, it can sweep back over. This chart right here shows you how interest is calculated. So we take whatever the balance is at the end of the day. You multiply that by the interest rate, divide by 365. That's how much your 1 day's interest is. So the point here is that from when you make your deposit, you immediately reduce the principal down on the loan. Every penny you deposit goes to reduce your principal balance. Okay, the interest is then calculated for that night, is totaled up, and then withdrawn out of your account on the 21st of the month. Okay, you don't actually have to write checks to do that. As long as you have room on your HELOC line, your all-in-one HELOC, they'll just pull out the interest on the 21st of the month. Okay. Now, I talked about this briefly before, but when you have bills to pay, the money will sweep the other way. At the end of the night, they'll see, oh, Mr. Jones wrote a check for $500. They will grab $500 out of your HELOC and automatically sweep it over to your checking account to cover that check. Let's use some numbers now to see how powerful this is. So we're going to use these clients right here. These clients make $150,000 after taxes. Typically on it, they are spending about 70% of what they earn to cover their mortgage and household expenses. That means they have 30% left over per month, around $3,750. They're looking at buying a new home. They're going to sell their old home, and it will give them enough to do a 20% down payment. Right now, rates are about 6.5% on that new mortgage. That's what principal and interest would be right there. And then currently right now, the all-in-one sits about right there. And you're saying, hey, Miles, that rate on that all-in-one loan is a lot more than that traditional loan. Yeah, that's a good point. We're going to look here in a minute to see and show you, and I'll keep reminding you of this. It's not so much about what the interest rate is. It's more about how much can we save you in mortgage interest by using the power of this sweep account and the HELOC, right? We're doing simple interest, not amortized interest. So here's kind of a visualization of how this works. So these guys are going to start 500,000. The guy gets paid once a month. The deposit comes in and the full amount drops down immediately, the new balance, right? You remember that you make the deposit, every penny of that goes towards reducing your mortgage balance. Then throughout the month, they spend and do their normal spending on things. Remember that we were anticipating they'd have $3,700 left over. Okay. That becomes that available equity because they didn't spend it. And this amount, normally, so we're able to do this for our clients without really changing their budget. Their idle money is just left over and remains in that account, reducing their balance. Okay. So we're really not changing anything as far as how much they're spending on their bills. And we're just using their idle money that wasn't spent, including on the 30-year mortgage, helping to reduce the balance. Then we come to month number 2. We get paid again. The new balance is lower. Then we have our normal spending for the month. And now we have an interest payment for month 1 that we make on the 21st day of month 2. Okay, that comes out as part of it also. But remember, every single month, we're having somewhere around $3,700 left over. So there's our new balance, and our equity position has grown because of that money left over. It repeats again, month 3, our monthly spending, interest payment also happens on it. And with what's left over, you can see our new balance has increased our equity position again. And it's just, not only is it increasing our equity position, but our mortgage balance has gone down significantly. That is reducing the amount of mortgage interest that we are paying. Okay. So let me remind you of our scenario here, because we have on our website a really cool simulator. And we take these scenarios for our clients and we put them in and we compare what would the traditional loan look like versus the all-in. We take into account the monthly cash flow and how much they have left over to see if it makes sense. And it will help tell us if it makes sense. So taking this Jones, we'll call them the Joneses, their scenario, and we put it in, this is what their numbers look like. This is the results page. So on the left, we have the all-in-one loan. On the right, we have the traditional mortgage. And you can see that in the all-in-one mortgage, it is projected that they will have this paid off in 8.6 years, which is awesome, crazy. What will it save them over the traditional mortgage? $437,000. That is absolutely amazing. Okay. The 30-year mortgage, yeah, it had a lower interest rate, but look at how fast our clients got paid off here and how much it saved them in interest. It's pretty phenomenal. We also, on the website, once you run your scenario, you can look at this pay down table. So this is month 103, which is 8 years and change. You can see that the loan balance on the all-in-one, that's when it hits 0. We've paid the principal down, paid $500,000 and paid it to 0. If you wanted to know where the 30-year mortgage would be at that very time, it would still have $437,000 left on it. And those 8 years that you've been paying, only $62,000 has gone to principal. Pretty crazy, pretty crazy. All right. So here's our chart again, or our representation of the all-in-one HELOC. Notice how there is so much flexibility on this that as the loan principal pays down, maybe it's time to pay for your kids' college. And you keep working at it, you pay it off. And then my favorite one in here is they got their all-in-one paid to 0. And then they said, let's buy an investment property. And they drew money out and paid cash for it. Now they have the rents coming off that investment property, plus their normal deposits coming in, paying down the all-in-one again. And you can see some of the other reasons that people may draw funds out of the all-in-one. It is completely up to you what purposes you use those funds for when you draw it out of the all-in-one. You're going to have checks. You're going to be able to wire. You're going to be able to do bill pay. You can absolutely do whatever you want with those funds. Let me just summarize these top 5 benefits for you here. Some of them I've hit on. I want to make sure I really hit this home. this really can save you a lot of money in mortgage interest. Okay. As long as you're a cash flow positive borrower, it'll save you a lot. Most of my clients are paying off their mortgages. Oh, it's anywhere from 4 to 8, 9 years, just depending on everybody's individual situation. And they still maintain and keep liquidity. Like it says right here, access home equity for 30 years without refinancing. That's awesome. You essentially become your own bank at that point. Now, there are times also that my clients, maybe business is slow for them. Maybe they're a real estate agent and they're in a little bit of a slow time, middle of winter. They can just make a small interest-only payment if they need to. And really, it gives them some flexibility and protection there also. All right, let's take a look at some of the top features here. Principal is taken care of first. There is no other loan product out there where you make a payment and every penny of that payment goes to reduce your principal. Okay, you can make a small deposit, a large deposit, and then deposits are usable equity immediately. Let's say you had a $10,000 commission check drop into your all-in-one. The next day you could turn around and draw back out that $10,000. And then again, up to 30 years use for it. And interest recomputes every single night based on what the balance on the loan is. Okay. All right. I love this concept of becoming your own bank. I tell my clients sometimes that you do an all-in-one loan, you get it paid down. You may very well never do another mortgage again. You can access these funds to help acquire additional properties. I've used mine to acquire additional investment properties, give short-term loans to people. I put a war chest here because I think and I consider this becoming your war chest or your own bank, that you can do things to continue building wealth. So my simulator's on my website. It's also on a website I have called allinonemortgage.com. And this page is dedicated to the all-in-one mortgage. And you can sign up and get access to the simulator. It's free. And then there's also a little video that walks you through how to fill out the simulator and to get that giving you the right numbers. I'm also available to do calls with you, review your scenario, help you strategize, and answer your questions to see if this makes sense and is a good fit for you. Okay. Here's a list of people who this is really good for. The bottom line to it all is if you are making more than you are spending, you should look at an all-in-one loan. It really can help accelerate your debt payoff. I love commissioned earners on here because maybe you have a few good months and you really pay down your mortgage, but then maybe there's a slow month and you need to draw some back out. Totally cool to do that. Self-employed borrowers. So a lot of them have rainy day funds that they don't drop into their 30-year traditional mortgage because they won't have access to them again. I have seen so many people just be able to really reduce their mortgage interest tremendously by using some of those funds to pay down the mortgage, knowing that they can draw them back out when they need it. Okay, here's just a quote from a past client about the all-in-one loan. We have lots of client testimonials on this. All right, frequently asked questions. So this is really good because these are questions that I want to make sure I have answered for you. How many all-in-ones can you have? You can have 3. You can have 1 on a primary, 1 on a second home, and 1 on an investment property. I generally tell my clients, if you have multiple investment properties, I like putting the all-in-one on your highest valued investment property because then it becomes a bigger war chest for you. Is there a prepayment penalty? Nope. You can, none at all. What makes this better than the HELOCs from the banks and credit unions? Good question. Very simple. Number 1, sweep feature that combines the loan, the mortgage with banking features and automatically sweeps back and forth every night for you. Part of that also is that the rates on the all-in-one typically are lower than a local credit union HELOC. They may offer a great intro rate, but we have found the all-in-one to generally be better than their rates. Then another one, as I've mentioned before, the all-in-one is open for 30 years. The local bank HELOCs freeze after 10 years and then force you to pay it back for 20 years. Next question, can the bank freeze or call my HELOC, my all-in-one due? So this is a huge question. So let me give you some history here. So all-in-one started in 2005. It's actually been around for a lot longer than that. It's used in Australia, New Zealand, Europe, Canada. So it's not a new concept. It just was brought here to the US and started in 2005. So let's fast forward then to 2008, 2009 during the recession there. Okay. A lot of banks and credit unions called up their borrowers and said, hey, you got that HELOC from us. We're going to freeze it or reduce the amount that you can draw out of it. Okay. During that time, none of the all-in-ones were frozen or reduced. And in fact, to this date, there has never been an all-in-one default on a loan. It just shows you that top-notch clients are doing these loans. They give them to the best of the best, and the clients are using them in a really solid way to be able to build their wealth and pay off their homes fast and save mortgage interest. So technically, could the banks call your all-in-one due? Yes, they technically could, but we have a really nice history and point to look back on and to show that during the Great Recession, they did not freeze or reduce, and the clients did not default. The banks we're dealing with, two great banks, North Point Bank and Merchants Bank of Indiana. These guys are fabulous. They have dedicated departments to the all-in-one loan. So when you call up, you're dealing with experts on this, just not some run-of-the-mill teller that doesn't know what they're doing. I have been so impressed with these banks and their customer service. How long has it been around? Since 2005. Is interest tax deductible? It can be. So at the end of the year, you get a 1098. And since this is first position mortgage, it could be tax deductible. A lot of it just depends on you and your CPA if you're taking standard deductions or if you're itemizing. Commercial properties, unfortunately, no, it can't. I've heard that there are some commercial versions of this property available. I'd love more info on them, but I'm not aware of any specifics there. But ours are for residential properties. So that means primary residence, second home, investment properties up to a fourplex. Is there a minimum draw or initial draw requirement? Yes, there is. So if you have a free and clear property and you want to put an all-in-one on it, you need to be pulling out anywhere from $60,000 to $100,000. They just won't give it to you and not have you take any money out at closing. You need to take money out, and you need to have a legitimate reason for taking the money out. A remodel, building a shed at your property, whatever, a shop. You need to buy inventory for your business, whatever it may be. But yeah, you have to draw money at closing. Annual fees or monthly fees. So if you pay this to zero, you won't be paying any interest on it, but there is an annual fee with a bank account. It's very much like the kind of service fee you would have with your normal bank. Like, I think it's $15 a month, I think is what it is. It's very small. Closing costs are typical to any purchase or refinance. So they're going to be identical with like title fees, appraisal, underwriting fees, just like that. The one thing that the all-in-one does not have is what we call escrows, or setting money aside for property taxes and homeowners insurance. And why is that? Because we want you to keep that money in your all-in-one account, not the lender's escrow account, so that it can reduce your mortgage balance and save you interest. Then when your property taxes come due, you can pay them yourself out of your all-in-one. Origination fee, it depends on whether the client how much they're taking on initial draw. If it's large, then sometimes I can not do an origination fee, but if it's small, there could be an origination fee. We take that case by case. Can you close in an LLC? No, you cannot. You need to qualify and be underwritten individually and close in an individual name since this is a residential mortgage. Can you then move it into an LLC that you own or manage? Yes, you can. Full doc loan just means that we will be looking at tax returns, pay stubs, credit reports, bank statements, all the above. Are there reserve requirements? Yes, 10 to 15% of what the credit limit is. Is there a limit on the number of financed properties? Yes, there can be. I'll show that to you on the next slide. I've already answered that one. How does this report to credit? It shows up as a mortgage. It'll show current balance and calculate a payment. It does, that balance will update on there. So yes, it does report as a mortgage. How long does it take? About 30 days or a little bit less for a purchase. And I tell my clients 30 to 45 days on refinances. Declining income, it just references my self-employed borrowers who maybe had like a really great year in 21 and then a little bit slower year in 22. That's declining income. And those are tough to get done. So if you have declining income, let's chat and strategize on how we can make things work. Velocity or infinite banking is utilizing sometimes a small second position HELOC or a whole life insurance policy to draw funds and then strategically pay off debts. It's a debt accelerator strategy. The all-in-one can be used as a debt accelerator strategy where you're grabbing that and paying off your other debts and doing that very much so, but it is technically not velocity or infinite banking. Non-warrantable condos, if you know what those are, then yes, we can do them in an all-in-one loan, but they have to get an exception. They have to be specifically approved and reviewed by the lender. All right, here's our 2023 updates. This matrix is also good for you to look at, that you can see how much down payment you have to have, minimum credit scores. And so the arrow there shows that now we can go up to 3 million on our loan amounts, which is phenomenal. That's awesome. You'll also notice that we can go up to 90%, which means a 10% down payment. If you do that, there is going to be some mortgage insurance required that you have to pay. And it's a single premium mortgage insurance. So that's why typically most of my clients only do or will do at least 20% down to avoid that mortgage insurance requirement. Here's the second homes, same thing here, up to $3 million, which is awesome. Now, investment properties, very cool change here. So in the past, when we can do investment properties up to $1 million. In the past, if you had an investment property that was free and clear and you wanted to put an all-in-one on it, they would only give you up to $250,000. That's now been bumped up to $500,000. That's a nice adjustment. If you are trying to do an all-in-one on an investment property that is free and clear, give me a call. We need to talk through those because there's some nuances with that on how to make that work. So very cool. All right, a couple of other updates here. So cash out refinances. A cash out refi is anytime you are pulling extra cash out beyond the mortgage that you have on the property, or even if you don't pull it out, but you raise up and put that credit limit in place, that's still cash out. You have to have owned the property for at least 6 months. And there are some exceptions where, like, maybe it was in the family, or it was in a trust, or it was in an LLC that you owned and now it's been moved into your name. Those are kind of the exceptions. So 6 months of owning the property. Escrow holdbacks are situations now where like a roof needs to be repaired or put in place or landscaping done. So they're now allowed if it's new construction and the weather is causing the reason why the work is not done yet. Here's our financed properties. So if you're doing an all-in-one on a primary residence, you can have as many other financed properties. There's no limit. Okay, but if you're doing a second home or investment properties, one of our banks will allow you to have up to 20 financed properties. That's pretty cool. All right, new change here. There's a lot of clients who are doing mother-in-law apartments or accessory dwelling unit income. So in order for us to count that income, we need for sure for you to have a 2-year history of managing and earning accessory dwelling unit income, and it has to be reflected on your Schedule E for 2 years. Okay, so yeah, if you're trying to buy a home that has a mother-in-law apartment and say, hey, I want to count the rents off it, it's going to be hard to do that. Okay, if you're refinancing and you have shown that for 2 years on your taxes, no problem, we can count it. If you're departing or leaving a primary residence that you are then converting to a rental and you want to count that rent as income, you need to have a 12-month lease signed and in place. Okay. Texas. So if you're doing an all-in-one on a Texas primary residence, there are some unique rules and requirements with that. I won't dive into it, but give me a call. Let's chat through those, and I'll let you know what the differences are on those Texas primary residence all-in-one loans. Here's my contact info. Please feel free to reach out to me with questions on your all-in-one or leave comments below. We love them. We love hearing about them. I love helping strategize on these. I think it's a phenomenal loan. So thanks for taking the time to watch this video. There are other videos on this channel that you can watch and will help you learn more about the all-in-one loan.